Welcome to the deep dive. We're constantly flooded with information and trying to stay truly well informed without getting totally overwhelmed. It's tough. So today we're aiming for a bit of a shortcut. We're going to unpack a really vital concept it's changing how businesses operate and how investors think. We're diving into environmental, social, and governance principles, ESG, and specifically how they're getting baked into enterprise risk management or ERM. And this isn't just for the finance pros out there. Honestly, it's key for anyone who wants to understand, modern business, sustainability, and where smart money might be going. Our goal today, pretty simple. Break down what ESG actually is, why companies and investors care so much about it now, and then the really interesting part, how it fits almost naturally into that existing ERM framework to help secure a company's future. Okay, before we get into the weeds, just a quick heads up. This deep dive draws heavily on material from Farhat lectures. All the content, the examples, the explanations, we'll be talking through it all, comes from the really comprehensive accounting resources over at farhatlectures.com. So whether you're studying accounting, prepping for the CPA exam, or you're already a professional, definitely check out the website. They've got extra practice questions, video lectures, tons of support to really nail down what we cover today. Big thanks to Professor Farhat for making this great material available. All right, let's dive in. ESG. Before we talk integration, let's just baseline. What exactly is ESG? What do those letters mean? And why is it suddenly everywhere?
Right. So ESG stands for Environmental, Social, and Corporate Governance. You can think of it basically as a framework, a lens, really, that investors and companies use to look at an organization's impact and its performance beyond just the bottom line, beyond the traditional financials. It's about how a company affects the planet, society, and, importantly, how it's actually run.
Okay, so it's a broader view. But why the explosion in interest now?
Well, its importance has really skyrocketed because, frankly, investors are paying serious attention now. A growing number are factoring ESG performance right into their investment choices. It's definitely not just a nice-to-have anymore.
Not just optics.
Exactly. Some funds, big ones, will only put money into companies that hit certain high ESG marks. The thinking behind it is pretty straightforward. The assumption is that businesses that are genuinely sustainable environmentally, socially, in their governance are just more likely to give better, more stable, long-term returns.
Resilient.
Resilience, exactly. Good ESG policies are seen as a signal of disciplined, forward-thinking management. And, there's data backing this up. Studies show companies with strong ESG scores often benefit from a lower cost of capital.
Interesting. So doing good actually makes financial sense.
It absolutely can.
Yeah.
It shows the market you're managing risks effectively, thinking long-term.
You mentioned investors looking beyond immediate profit. That Tesla example you brought up earlier really hits that home, doesn't it?
It really does. Think back to early Tesla. They weren't consistently profitable for a long time.
Right, burning cash.
Burning cash. But people poured money in. Why? It wasn't just about the current balance sheet. It was belief in the mission, the environmental mission, to shift away from gas cars. It perfectly shows investors backing a sustainable vision, sometimes over short-term profits, because they believe in that E factor, that long-term environmental impact.
Okay, Tesla's a clear ease case. But let's break these down a bit more. What does E for environmental really cover for, say, a company that isn't making solar panels or electric cars?
Good question. The E is fundamentally about how a company acts as a steward of the natural world, managing its footprint. So even for a company not in the green industry, this means looking hard at things like energy use, energy conservation, how they handle waste, pollution control, conserving resources, even animal welfare, if it's relevant.
Okay.
And it's also crucially about managing environmental risks. Think about oil companies, the risks they face, or manufacturers dealing with potential carbon regulations. But even, say, a standard manufacturer might look at its supply chain to cut emissions or find clever ways to recycle byproducts. And often that saves money too, boosts efficiency.
Right, so it's not just cost, it can be savings. Okay, moving to S social. What kinds of relationships fall under this? Is it just about employees?
It's broader than just employees, though they're a big part. SES looks at a company's whole network of relationships. Employees, yes, but also suppliers, customers, and the community it operates in.
The whole ecosystem.
Pretty much. So are you working with suppliers who share your values on things like labor laws or environmental practices? How do you treat your own people? Is it a safe workplace? OSHA compliance is a baseline, of course, but also fair pay, work-life balance, fostering a positive culture. And then there's the external piece. Community engagement. Does the company donate profits? Encourage volunteering. Participate locally. It's really the human side of being a responsible corporate citizen.
Got it. And that brings us to G, governance, how a company polices itself, you said. This feels like the bedrock.
It really is foundational. Governance, the G, is all about how the company's led, managed, controlled. It's the internal rule book, the operating system. So this covers company leadership, how executives are paid, the audit committee's independence, internal controls, making sure shareholder rights are protected.
Transparency seems key here.
Absolutely. Investors demand accurate, transparent accounting so they can actually understand what's going on and vote meaningfully. It's about avoiding conflicts of interest on the board, making sure directors are truly working for shareholders. And, basic ethical integrity. No dodgy political contributions to curry favor. It boils down to building trust through honest, clear leadership.
Okay, so we have E, S, and G. Clearly important stuff. But this is where it gets really practical. How do companies avoid this just being a separate report, a checkbox exercise? The source material really stresses that ESG risks shouldn't be separate from ERM, enterprise risk management. Why is integrating them so crucial? Why not just have an ESG department?
That's the million-dollar question, isn't it? The fundamental idea is that strong ESG practices aren't just window dressing. They actively protect a company's long-term value and make it more resilient. Think about it. If you're managing your environmental impact well, treating your people right, and running the company ethically, that signals strong, forward-looking management. Investors like that a lot.
Right, it signals lower risk overall.
Exactly. So weaving ESG risks directly into the established ERM framework, instead of having it as a side thing, ensures it becomes part of the company's core strategic thinking. It gets embedded in the DNA, not just tacked on.
Okay, so let's walk through that weaving process. ERM has those 5 components, starting with the first one, governance and culture. This is the tone at the top, the company values. How do leaders make sure ESG is truly part of that DNA?
Well, for governance, it's about having the right structures and processes. You need board-level oversight for ESG, maybe even dedicated committees. You need clear policies saying, this is where we stand on ESG. You need to assign responsibility who owns these risks.
Specific people.
Specific people, yes. And critically, you have to factor ESG into strategic planning. Every major decision needs that lens. Plus, accountability. Incentives for good ESG choices, consequences for bad ones, and reliable data systems to track it all.
And the culture part, that seems softer, harder to pin down.
It can be, but it's vital. Culture is about those shared values and behaviors around risk. The tone at the top is huge here. Leaders need to visibly champion ESG through their actions, their communications, not just memos.
Walk the talk.
Precisely. Then there's training everyone needs to understand their role. Fostering a risk-aware mindset means encouraging people to think about ESG impacts in their everyday work. Open communication, transparency about risks, clear channels to raise concerns. It's about creating an environment where continuous improvement on ESG is just normal.
Okay, strong foundation set. Then comes strategy and objective setting, the second ERM piece. How does ESG get woven into the actual long-term plans and goals? This feels like where strategy really happens.
It is. This step shows ESG as an afterthought, but part of the plan from day one. It means aligning your ESG risk management efforts with the company's overall strategy and setting specific, measurable ESG objectives. Not just vague goals, but things like, we will reduce energy consumption by 5% this year, or hitting certain social impact targets.
Quantifiable things.
Quantifiable things, yeah. Using scenario analysis, those what-if exercises, helps understand potential ESG risk impacts down the road. Then you need to allocate resources budget, people to actually pursue these ESG goals, and keep communicating why it matters, internally and externally. It's an ongoing loop.
Which leads perfectly into performance, the third component. You've set the strategy, the objectives. How do companies actually track if they're hitting those marks? How do you measure ESG performance effectively?
Right. Performance is all about measurement and monitoring. You need a solid framework to track, report on, and feed ESG performance back into business decisions. This involves setting up key risk indicators, KRIs, specifically for ESG. These give you early warnings.
Like a dashboard?
Kinda, yeah. And clear performance metrics, maybe greenhouse gas reduction measured in tons, or tracking improvements in labor practices through employee surveys. Benchmarking is important too. How do we stack up against peers or best practices? Regular reporting, both inside the company and out, creates transparency and accountability. And tying incentives to hitting these ESG targets, that really gives it teeth.
Makes it real.
Makes it real. And you need the tech data analytics platforms to become essential to gather, analyze, and make sense of all this ESG data. Plus, ensuring you're complying with all the relevant regulations, and having regular audits.
It sounds like a continuous loop because things change. ESG isn't static. So how does the fourth component, review and revision, keep the ESG approach sharp and relevant within ERM?
You hit it exactly. It is a continuous loop.
Yeah.
ESG factors evolve, stakeholder expectations shift, regulations change. So review and revision is absolutely critical for keeping the whole system effective and responsive. This means regular check-ins on policies and procedures. Are they still current? Do they align with what's happening inside and outside the company? You need to evaluate your performance metrics. Are they still the right ones? Are they effective? You incorporate findings from audits, both internal and external. You constantly update to stay compliant with new rules. And crucially, you learned from the past. If there was an ESG issue or incident, those lessons must be fed back into the risk management process. It's about fostering that culture of continuous improvement you mentioned earlier, always adapting.
Okay, final piece of the puzzle. Information, communication, and reporting. The fifth ERM component. How does getting the right information flowing ensure ESG stays central and isn't just siloed?
This component is really the nervous system connecting everything. It's about a structured way to get information flowing effectively, both inside the organization and out to stakeholders like investors, customers, and the community. It starts with solid data collection, gathering both quantitative data, like emission numbers, and qualitative insights, like employee feedback.
Both hard and soft data.
Exactly. You need robust IT systems for this software to track sustainability metrics, manage incident reports, handle stakeholder info. Clear internal communication protocols are essential, making sure everyone from the board down to the front line understands the relevant ESG issues. Externally, it's about communicating risk and performance clearly in annual reports, dedicated sustainability reports, press releases. Engaging stakeholders actively, inviting dialogue is key.
Being open.
Being open, yes. Reporting accurately to meet legal and voluntary standards. Getting external assurance on your data adds huge credibility. And having a crisis communication plan ready for any ESG-related incidents helps manage the fallout. It's all about keeping information moving and using it effectively.
Yeah, okay. So putting it all together, what we've really unpacked today is that ESG isn't some passing fad or just a buzzword. It's becoming a really fundamental, deeply woven part of how smart companies manage enterprise risk management. It touches everything.
It really does.
And doing it well influences long-term success, resilience, and definitely attracts investors who are thinking about the future, not just the next quarter. By integrating E, S, and G into all 5 ERM components, governance and culture, strategy and objectives, performance, review and revision, and information and communication companies aren't just ticking boxes. They're building genuine, sustainable value.
That's the core message. Absolutely.
Now, to really get a handle on how this works in practice and maybe test your own understanding, those supplementary resources are super valuable. Remember to check out farhatlectures.com. They're the extra practice, the videos, all the support material there can really help cement what we've discussed. It leaves me thinking, though, as ESG keeps evolving and its importance grows, how might our whole definition of company success start to shift even more? Moving beyond just financials to capture that broader impact on the planet and society. Something to ponder.
A very important question for the future.
Indeed. Well, thank you for joining us on this deep dive today. Keep exploring these ideas, keep learning, and we'll catch you next time.